Okay, so we are going to start with some partnership information today and learn about what's different about partnerships. Since we already know about individuals and we already know some about corporations now, I'm just going to add this partnership and try to get in our head around the nuances that relate to partnerships. Okay, so there's, you know how the corporations are under subchapter C and the S corporations are under subchapter S. Well, the partnerships, they don't usually mention it whenever you're just working with the returns for partnerships, but they're under the Internal Revenue Code's section Title 26, subchapter K. These are examples of flow-through entities. So the subchapter K and the subchapter S are both talking about flow-through entities, which means the entity itself doesn't pay any tax, but the individuals that own the ownership shares of those entities are who pays the tax. So we'll talk about that a little bit further on in here, but we're going to use the Schedule K1 in both instances for the subchapter S's and the subchapter K's to let the income items that are to be reported to the individuals, they'll be reported on a Schedule K as far as the summary of them, and then each individual owner will get a Schedule K1 that lines out all the little pieces of income or loss or expenses sometimes that would flow out to each shareholder or partner. Okay, so for this chapter, we're talking about the partnership part, and we generally will be talking about general partnership, but there also are limited partnerships and there are limited liability companies that are considered the same as a partnership for tax reporting. So we will just discuss some of these and give you just like a broad understanding. This information in this chapter is just a little edge of the information, little tip of the iceberg, because you could do a whole course in college in master's level usually about partnership taxation. So very deep subject, but we're going to make sure we get our head around the basic concepts that are behind it, at least some of them. All right, so the first thing we'll jump into is reporting the results of the partnership's operations. And that's the thing I was talking about, where you show on the partnership tax return, even though the partnership's not going to pay any tax, they're going to have to file a tax return on this form 1065. And then there's going to be a schedule in there that says Schedule K, and it is the summary of everything that the company made that needs to be reflected on the individual's returns, but it's the total of all owners. So you'll have ordinary business income from the partnership, and it'll be reported on the first page of the 1065, and then the bottom line, net income, basically taxable income to the partnership, if they were a taxable entity, would be then distributed to those owners as whatever their ownership share is, their profit and loss sharing percentage. Well, actually, it could be different than their ownership share, but it is their profit and loss sharing percentage that will be applied to the net taxable that the partnership's reporting. So at the bottom of page 1, you've got this, or near the bottom of page 1, you've got this summary total of what happened to the operations of the business, the revenue minus expenses, bringing you to this subtotal for the taxable, which I don't think they actually call it taxable income, but the net that came from the partnership that's going to be distributed. And so that ordinary business income would be a line item on Schedule K, and then each individual owner's K1 would have that same amount times their profit and loss sharing percentage. And then you would also have a lot of other items that are called separately stated items, and these are just a few that I'm giving you, even though I look like I have a long list of separately stated items. There are a whole lot more. And so these are the ones you'll see most commonly, and hopefully I haven't missed any, but most of these I've seen repeatedly as I deal with clients, individual clients that have ownership in these partnerships. And so the separately stated items, most common one, of course, is interest income, because if the partnership earns interest income, they don't show it with their ordinary business income. They have it as a separate stated interest income line. And so that is a factor on the K that flows out to the K1s for each of the individuals. Then another thing that shows up that's a little bit new, because not a little bit, a lot new, because it's partnerships, is this thing called guaranteed payments. So guaranteed payments are similar to a salary that you would pay to an owner, because what it is the designated amount that we say is due to that particular partner. And so if you had a partnership that had, say, 12 people in it, and most of them were part-time because they worked somewhere else and they just worked here on the side, but this one person invested a lot of time, then you would probably set them a guaranteed salary that would come out of the ordinary business income. In other words, once you knew how much the company made, or even before you knew, you had set aside an amount that says, regardless of what the bottom line profit's going to be from this operation that we're in partnership for, we're going to make sure this person gets paid for their effort because they're investing so much time. So that's why you would set a guaranteed salary. So maybe the partnership, you're expecting the partnership to make $100,000, and you will share equally the net amongst the partners as far as who's reporting it. But one partner is investing a lot more time, and so you allocate 40,000 of the 60 to say this is guaranteed salary for this person, and so they get a guaranteed salary, which means they actually get the cash and as like a draw, but it's a guaranteed draw, and then the rest of the profits would be distributed as taxable to everybody, including that guaranteed partner. And so the guaranteed salary would show up as a separate line item just on the investor, or just on the partner's K1 that was given the guaranteed salary. And so it could be a salary, but a lot of times it's other things too. It could be some kind of guarantee of some other service that they're providing, but mostly it's because of their effort that you give them a guaranteed payment. But there are other things you could give them a guarantee of, like property rentals or some other thing that they're providing that is not being provided by the other partners. But in any case, it could be more than one too. It doesn't have to be just one. But if you have a managing partner that is dedicated to making sure the partnership rolls and everything works well, then a lot of times there's that guaranteed payment. But when it happens, it shows up not in the ordinary business expense like as if they were salaried. It would show up as a line item that would be reportable to that partner. Hang on just one second. Okay, I double checked that. No, I misstated that. The guaranteed payment does show as a deduction on the ordinary expenses, but then it shows up again as an income factor to just that guaranteed partner. But in any case, sometimes self-employment tax is triggered from the guaranteed payments as well. If it was for services, it would be. And then in all cases for partnerships, if they're the partnership interest would be subject to Social Security tax to each partner. So on the person who received the guaranteed payment, they would have two factors that were coming into how much is taxable for Social Security taxation. And there's a line item on the K1 that shows how much needs to be included. So for that person that got guaranteed payments, it would be their share of the ordinary business income and their guaranteed payments that relate to their services. And then there's another line item that's going to be separately stated is net rental real estate income. So basically, you would not show on the first page of the 1065 if it was you wouldn't show all the revenue and all the expenses related to rental property. You would show a line item for net rental real estate that would go as a separate state instead of part of their ordinary income. And then charitable contributions similarly are not deducted on the face of the return. They're deducted on the as a separate line item and pushed through the Schedule K. And then Code Section 179 expense also. The reason for some of these being separate is that they're limited at the final taxpayer level. So you wouldn't know for certain if you could take it as a deduction until you got to that individual tax return. So that's when they put it as a flow through, going through the K to the K1s of each individual, and then that their preparer would decide if they were able to deduct it. In other words, charitables may or may not be deductible, depending on if you itemize deductions or take the standard. And so then you got that business interest limitation, and it has to be aggregated with other business income in order to decide what the limitation would, where the limitation would fall, and also see the taxable income for the or the AGI for the taxpayer or partner. So it flows out also as a separately stated item. Qualified business income similarly flows out to the individuals. Net investment income flows to the individuals, and then the evaluation of whether of what's to be done with it. In other words, net investment income is normally there so that you could decide whether you're able to deduct your net investment interest. And so all these things that go separately have a reasoning behind them. I'm not going to dig into all that, but that's why they're separately stated, is because there's some need for them to be separately stated when you get to the individual return, because since everything that you're showing in a partnership is going to flow through as a flow through or pass through to that individual return, it means, well, there's a few exceptions that would be taxed to the partnership, but we're not going to dig into that. That's some of the complicated issues that would show if you did a partnership taxation class. But and in real life, sometimes you have to dig out and figure out what that is, like the built-in gains and that sort of thing. But there is some occasion where you would see a tax on a partnership return. It's just very rare. Okay, now some of the compliance issues I mentioned, Form 1065, that's the form we use for partnerships. It's due by the 3rd month, 15th day after the year end, which will be March 15th for calendar year taxpayers. The Schedule K, I mentioned already, it summarizes the partner's share of all the items being reported. The K1 is each individual's partner. Each individual partner gets reported their share of these reportable items. And then if you need to do an extension of time, you get an automatic 6-month extension, but only if you file the extension form by the due date. So the Form 704 is used to get a 1065 extension. Then partnership formation and acquisitions. Okay, so when you start a partnership, a lot of times individuals will donate, or they will contribute their own assets that are related to the business, and that would be what starts the organization. So whenever individuals put assets into the partnership, they normally transfer at whatever their basis was in the hands of the partner, and then the partner would hold that same amount of basis as how much they have invested in their partnership interest. So here's how it works. You also, of course, have to tweak for different things that happen. So, okay, if you got if you started a partnership and the individuals, let's take just one individual, just keep it from getting complicated. One individual is going to contribute property like a building or equipment, anything that could be used for the business. And what they would do is they put this property in exchange for a partnership interest. And so that the basis they would have would be whatever their carryover basis was in the asset they just put into the partnership. And if there was some debt against it, like you had a building, but you owed still on it and you put it into the partnership and the partnership took over the debt, then what you would do is you would take your carryover basis in that property and you would reduce it by the debt that was attached to it. So if there's a debt attached to an asset that you move into the partnership, you reduce the basis by the amount of the debt that you just got relieved from. Okay, and so that's the contributed property. If it has debt on it, you reduce your basis. So I'm saying that because that's important that you know which debt is it that's going to reduce. Okay, so because the very next thing we're going to talk about is if you assume some of the partnership's debt, then that increases your basis. So that is an add back to basis. I get that to go away. Yeah. So you see the first two items I just talked about, when you contribute the asset, that's part of your basis in the partnership. But also if some of it had debt on it, like a mortgage, then you'd reduce the amount of basis that you're counting as the partnership basis by the amount of debt that the partnership took from you. So that was the first two. Now this one, we're adding a debt because this is where you as an individual partner are agreeing to assume part of the debt of the partnership. So that piece that you're assuming of the partnership is increased basis to you. So let's say you had a building that you're contributing and it had a $120,000 basis that you're carrying on your books, the net book value. And so net book value is 120, but you owe a loan on it for $40,000. So 120,000 basis minus a $40,000 loan means the net that you're pushing into the partnership is $80,000. And that's what your basis is going to be. If that's the only thing that happened, you would be $80,000 basis in the partnership interest you just acquired. And so that 80,000, you would look to see, do I have to add anything or subtract anything from it? You would add to that if you're also at the same time assuming part of the partnership's debt. So if you're a general partner, you're automatically going to be liable for the debt, the new debts that the partnership takes on. And so a lot of times the partnership agreement says if you take a 10% partnership interest, you're assuming 10% of the partnership debt as well. And so you would just say, okay, well, I had basis in the assets I transferred in, netted it out by the debt that I transferred into, so I got to $80,000. Then if my share of the partnership debt that I'm taking on as I sign the line to say, yes, I want to be a partner to ABC partnership, if my share of that is another $30,000, then my basis in the whole partnership investment now is $80,000 from the assets I contributed plus $30,000 for the debt I took on. Okay, so then if there was any gain related to the transfer, which is very unlikely because it doesn't happen very often, but it is possible. So if there were any gain recognized when you transferred, that would also increase your basis. But at the point we had 80,000 net for the buildings and the loan that we transferred in, plus a $30,000 debt we assumed that belonged to the partnership, but we agreed to take responsibility in case there was a default or something. So we're at 110,000 in basis. And we don't, if we didn't have any gain when we made the transfer in, then we would not have to include anything for that. So we would be at 110,000 for our basis. And the holding period is the other thing. We have to, two things you have to figure out about when you transfer assets into a partnership. You have to figure out what is your basis in the assets that are going in. In the partnership interest based on the assets that are going in, the debt that's attached to it, and the debt you're assuming. So what is your basis in your partnership interest now as an individual? And the second thing, what is your holding period? So that you'll know if you ever sell your partnership interest, if it's a short-term gain or a long-term gain. And so the holding period, if you're putting in assets that have a carryover basis, like real property, that's what Code Section 1231 is. If you have real property that you're transferring in, then that would be the holding period would be the same as it was in your hands when you were an individual. So your holding period on the partnership interest would be that same time frame. So if you bought the building 20 years ago, the holding period was 20 years ago, then your partnership interest gets to carry over that holding period. But that's for the 1231 assets. Otherwise, the holding period is going to start on that day that the partnership interest begins. So when you bought in. So most of the time, it's the holding period of the assets that went in that are the holding period for you. So if you sell your partnership interest within 1 year, it still might be long-term capital gain because it's that holding period is going with you. It's carryover, just like your basis would carry over. All right, so that's when you contribute property to the partnership as you're forming it. Now, the second thing that might happen is sometimes a partner, instead of contributing property, they'll contribute services. So if a partner could contribute services for their share, then that it depends on if what they're getting is a capital interest, like a full-blown, I am now a partner, I own for capital, I own for profit. Those, a full capital interest, you would have to show the services you provided to get that stock as revenue that you earned income to the tune of the whatever the value of the liquidation value, meaning whatever the value of the partnership share is at that point. And so that would be fair market value rather than these basis numbers that we would transferring in. So just because one partner transferred in and his basis is this 110,000 that we just talked about, does not mean that a partnership share of exact same percentage would be worth 110,000 on the fair market value. Because remember, he transferred it in at his original cost. So he carryover basis is what got him to 110,000. So instead of that, you would look at fair market value of the underlying assets minus the debts against it to see what the value of the share is that this services providing partner is getting. So this one, we're switching it to, when I say liquidation value, I'm talking about fair market value. So If you provide services and you're getting a full-blown capital interest, then you are going to have to show as income, services income, that you to report it, and then you'll have basis to the tune of those services as because of your the taxability of the services made it available for services to be your basis. That's those same services to be your basis in the partnership interest. So then, the same way that you did on the other one, you'd have to also add, if you to your basis, the amount that you took on or assumed of debt of the partnership. So the holding period would start for those that contributed services to get their share. The holding period for that one starts on the day they get the partnership interest. So this is during formation of a partnership that these basis rules apply. Later on, after the partnership is already established, most of the time when they take on a new partner, they're selling a partnership interest that's already existing. Not always, but a lot of times. But these are initial issuance of a partnership interest in exchange for either assets or services. But so I mentioned that if you provided services and you got a capital interest, this is what we would have to do. If you didn't get a capital interest, but instead you only had a share of profits interest, then you would not be taxed on the services, and your only basis would be the partnership debt that you took on or assumed whenever you came into a partnership. And the holding period for that would start on the partnership, when the partnership interest started also. But so here's the other thing I was about to talk about. If you acquired a partnership interest from someone else who was already existing, you bought it, then if you bought out a partner, then your purchase price that you paid for the partnership would be what your basis is, plus any debt that you assumed because of that acquisition, your percentage of the debt, that you would add that to your basis. And the holding period would start on the date of the purchase. All right, so now there's these terms: outside interest, outside basis, not outside interest, sorry, outside basis and inside basis. So outside basis is the basis that the partner has in the interest that they just own. The stuff we just talked about, that was how the partner was deciding what their basis is in that partnership interest. The inside basis is the basis that the partnership is showing in the assets that they're holding. So those assets that got transferred in to start the partnership, or assets that were acquired later, the inside basis includes the basis in those assets that the partnership is now holding. Whereas outside basis is just showing how much each individual partner's interest is, their basis in their partnership interest. And it could be vastly different amongst the different partners, depending on what they transferred in and what their basis was in the assets that they were moving in. Hang on just 1 second. Okay, so the next thing is this recourse versus non-recourse debt. So the recourse would be the part of the debt that the partners are personally liable for. So if you had a recourse debt at the bank, it would mean the loan was the bank was looking to the partnership to repay the loan. But if the bank doesn't, they can look to the partners to repay the loan. And so under recourse debt, it means the partners are personally liable. So it's allocated by the responsibility amount. In other words, whatever their share is of the debt. And so that's just how you just need to get straight in your head that recourse means the partners on the line as well as the partnership. And then non-recourse debt, only the partnership is liable. So it's allocated by the profit sharing percentage when you look at how much would show as each partner's part of that non-recourse debt. It's just by the profit sharing percentage rather than the their actual capital ownership. So, and these don't come into play most of the time because the partnership just takes care of all the debt. But you have to make sure you know what you're dealing with. Whenever you sign the line on a partnership, you're actually taking responsibility for whatever the partnership borrows. And if you have general partner, like most people do, managing partner, they can control when they don't like go to every partner every time and say, should we borrow some money? You would normally assign someone to manage the partnership. And so they could go to the bank, borrow money, and in your name too, basically, because it's the partnership name. And then the bank, if they're smart, and then most of them are smart enough to do this, would get the signatures from every partner to back that up, saying, okay, you are partially liable for this as well. Because without your signature on the bank forms, it would be a lot harder for them to collect from you if the partnership defaulted. So there's very few banks that would not just go ahead and have every partner sign that they were acknowledging that they had the responsibility to pay it if the partnership did not. Okay, so that's recourse versus non-recourse. Then partnership accounting, some of the tax elections, that the responsibility of the partnership is for the partnership to take care of, not individual partners. And the accounting period is calendar year normally, but it could be other times. But the way it's determined is the years should agree with the majority of the partner's year. So since most of the partners are individuals, usually, then that's why most partnerships are our calendar year. And so 50% or more of the partners is the majority. And if 50% or more of the partners have a calendar year, whether it's individuals or corporations, then they would that would make the partnership automatically be a calendar year partnership. If there's not a consensus, you don't have more than 50%, then you would look at the principal 5% plus anybody that owns 5% or more partner and look at their tax year and align with them. So again, if you didn't have corporations as partners, it's very little chance you would be anything but a calendar year under that. But if there's still no consensus of what, because like if you had corporations as your partners, they might have different years that they're different months for their year end. Sorry. And so if there's still no consensus, the third thing you would do was you would use the year that has the least aggregate deferrals. So we're not going to go through all that, but that's again another